I should be able to pull that up. All right, so the vol crush, the volatility crush is one we've been talking about a bit within our weekly meetings. So this is one that I've been working on quite a bit, and there's a lot of moving parts with this one because we are talking about a four-legged option spread. So, bear with me on this one, and obviously we're still kind of optimizing some parts of this trade too. This is a great one because we are talking about volatility that comes into the market or comes into the particular stock. And as Josh had mentioned earlier, when earnings is getting ready to come out for a stock maybe like Google, volatility is starting to increase because people are wanting to trade that stock as earnings is coming out. Most people want to be bullish Google. They think the stock's going to go higher. So the options premiums will go up based on that volatility. Volatility is going to go up. Option premiums are going to go up. And then that's what's going to offer an opportunity for a trade. And that's what we're going to discuss, is that volatility being higher. So after a company reports earnings, the stock price will move in either direction. It could either go up or it could go down. But typically, if the stock stays within that expected move range of what the market makers are expecting, there should be a decent drop in implied volatility in that particular stock in those options that are traded on that stock. So you can catch a move, based on that volatility crush or based on that implied volatility coming out of those options and make a profit while doing so. So Delphian calls this strategy a vol crush, also a volatility crush. Don't confuse that with volume. It is volatility. And again, the vol crush typically happens right after the earnings announcement. So the earnings announcement would happen tonight. And then after the announcement happens tonight, you'll see that volatility crush happen tomorrow morning. Maybe not right at the open, but shortly thereafter the open, you'll see that volatility crush happen. Some stocks move a little bit differently, like your Tesla, things like that. That volatility could increase or decrease a little bit, but I still think you have some good opportunities with those strategies on some of those stocks as well. The vol crush strategy is designed to capture a 20 to 40% gain for the iron butterfly spread the day after the earnings announcement. So again, the iron butterfly is a credit spread. So when I'm talking about a 20 to 40% gain, I'm talking about a 40% gain on the actual credit that you receive. So, if you receive a credit of about $1,000 for the trade, I'd be looking to close the trade out at a $400 profit if I could do so. So 40% of the credit that I receive. The trade is closed when any of the following conditions are met: profit target met, stop loss met, or the day after the earnings release. Typically, your stop loss isn't going to be met for a trade like this. You can test other theories, but for myself, I use a 400% stop loss. So I'm doing that expecting that my stop loss isn't going to be triggered. And the reason that is because I'm using an iron butterfly strategy. So that strategy has protection on both the call side and the put side. So when I put this trade on, I'm expecting a certain credit, and I'm comfortable with the risk of if the stock moves outside of that expected move or not. Again, the iron butterfly is designed to profit on a sharp reduction in the volatility premiums and a lack of movement in the stock price immediately after the earnings. So, the stock can actually move after the earnings, either up or down, but there is an expected move that is put into the market based on the options premium and where the market makers believe that the stock can move. So, when you're trading the iron butterfly, we're using that expected move as an area that we want to put the options of put the buy options, the buy call and the buy put as at the expected move. So if it does have a big spike or a big sell-off and it moves outside of that range, then we're protected. We're going to take a loss on the trade typically if it moves outside of that range, but we are protected. So what we really want to happen is we want the stock to, it can make a move either up or down, but we want it to stay within that expected move range. Again, the iron butterfly, it has a defined risk and it is a credit spread. Iron condors offer less potential profit than the iron butterflies typically, and that's because on the iron butterfly, you're selling the options at the money. You're selling a put and a call at the money. With your iron condor, typically you're going to sell options a little further out of the money on each side. So your credit for those particular options are going to be a little less. So therefore, your expected profit or the credit you receive is going to be less as well. Long strategies typically aren't going to be viable in trades like this because you're trading the volatility crush. You want that volatility premium to come out of those options. So if the stock doesn't move as expected, or it moves and still moves within those expected ranges, that volatility should come out of those options. So long strategies are typically going to lose money in a scenario like that. Short call spreads, again, bear call spreads or bull put spreads are potential trades. Again, you want to have a bias on the market. So, maybe a stock's at an all-time high, you don't think it's going to go higher. You've run some more analysis and that might not be possible. So you could test some of those bear call spreads, selling some call spreads above the market to see if the market pulls back off of earnings and you're still able to get that volatility crush. But again, that's just something that you want to test ahead of time and make sure you're comfortable with that type of trade and that type of risk. The trading strategy setup. So we have the iron butterfly, as you see here, as a strategy. We're going to enter days before is going to be 0, and we're going to exit days after. We're going to exit the day after the earnings. I'm looking for a 40% profit on my max profit, which again is going to be the credit that I receive for the trade because it is a credit spread. And my stop loss I put at 400% of my max risk. So again, with the fact of this trade being a short-term trade, I don't expect the stop loss to be hit. So typically I put that at a level to where it can't get hit with my back test, so I can see all of the numbers and make my own analysis based on that. I have days to expire as 1 because I want the back test for this scenario to pull in the weekly options. I'm using weekly options on this strategy. You can use monthly options when you're testing the iron butterfly strategy like that, but typically the options that are closest to the expiration, but not going before the earnings announcements, are going to be your options where you typically will see the majority of that volatility and that volatility premium go into. So if you have options that expire this Friday and earnings is today, you're going to see volatility premium in those options well before you'll see the volatility premium in the options that are expiring next week. So I always want to try to find the options that have the nearest expiration. Doesn't mean that the options with the further expiration are not going to work in that scenario, but the volatility crush is typically going to be seen more in the options that are expiring closer to the event that's going to happen, which in this case is going to be earnings. The strategy setup, you can see below for the iron butterfly, we're talking about 4 legs. So we're selling a call, selling a put, we're buying one call further out of the money and buying a put further out of the money. And the buy call and the buy put are basically there for protection. They're protecting us in case we get a bigger than expected move to the upside or the downside. The strike selection models in this one are a little bit pulled off the screen so you can't see them, but you can see them here. How I set it up is I sell one call and I sell one put, basically a 0.01% from the current closing price of the stock. So typically an at the money option, a put and the call is what I'm selling. And then I'm buying a call and buying a put, the expected move. So basically the expected move from the current closing price. So if the expected move is $30 and the current closing price is $500, then it's typically going to use that $530 call or that $470 put as those options that it's buying on the call side and buying on the put side for protection. Here's the screener that we use to find good candidates. And this one, again, as all the other ones are, they are customizable. So feel free to make some adjustments as you see that might work best for your strategy. I'm looking for the closing price 1 day after. In either direction, the move is going to be less than 20%, 7 out of 10 earnings. So I made this one really wide. And the reason I did that is because I want to pull in most of the candidates for the iron butterfly that I can, because I'm really going to be comparing this to the expected move. So I want to find those stocks that move, but again, I don't want to find the ones, I want to kind of limit it as ones that on average move outside of that expected range. So, if they move outside of the expected move more often than not, those are ones that I'm going to exclude. But in this scenario, I want to be able to pull in a bunch of candidates for, for my test, for the back test that I'm looking at. So the first one we're going to look at is Starbucks. So we can see Starbucks with the different earnings that they're having. You can see back here, Starbucks has earnings come out. Stock typically moves, fairly sideways. Here you can see the earnings come out. The stock actually did drop down quite a bit. Here you can see the stock drop down there as well. here you can see the stock actually pretty much went sideways. So I didn't add an expected move graph on here, but we can look, I can show you something within the system to show you kind of how I look at some of that expected move analysis for Starbucks. Here is the trade results for the past 10 earnings. So we're seeing, you know, the credit that we received and then the profit that we got out based on that, based on the day's move. So we're able to get out the next day on all these trades. You're getting in and then getting out the very next day. For Starbucks, we're looking at, you know, win percentage of 90%, 5.66 profit factor, and $634 total. Microsoft, let me go back to Starbucks real quick. I'll go into the system and show you Starbucks real quick. So give me 1 second. So there is one feature in the platform that you can look at. I'll come into my earnings analysis page. And I think maybe Josh had shown this earlier. If I type in Starbucks, you'll be able to see the graphs based on the past earnings. We'll be able to see a couple different graphs. So this is one that I typically will look at quite a bit. We can see the green lines are our expected move to the upside, and the bottom lines are expected move to the downside. So I really want to find symbols that typically stay within these ranges throughout the entire trading pattern or throughout those past 10 earnings. If they do, then that leads me to believe that it's possible or likely that it's going to do the same for the next earnings coming up. So that's where that iron butterfly or that vol crush trade will be in play. We can see here, you know, it hit the expected move there, went through there, through there, through there. So we have a handful of times it's actually broke through that expected move. But, you know, that just tells me that, okay, well, it does kind of touch that range sometimes, but a back test or testing this a little bit further might give me some better insight into, you know, what actually happens, or tracking this trade in a virtual portfolio will help me analyze it a bit further. So that virtual portfolio can be a key component in helping you make some educated decisions. You know, if you look at some other ones, I think, give me 1 second, like Microsoft maybe. And another great function of Delphian that you can do is if you have a big list of stocks that you want to analyze using different graphs, you can always create a personal stock list or one of the stock lists that we have in that earnings calendar and put it in this section here, and you can scroll through the stocks with ease based on the stock list. If you have a stock list of 5 stocks, 100 stocks, whatever, you can scroll through them. So I wanted to pull up Microsoft to show you one that typically does stay within the range, and we can see here it touched it. This one broke through, but other than that, it doesn't look like any other time within the past quarters, within the past 16 quarters, that the stock actually moves through that expected move. So this would be one that you would look at and say, well, typically it stays in there. And as long as I'm getting a good credit for this iron butterfly trade based on the risk that I'm taking on, you know, this might be a great stock to trade, or at least look at a little bit further, you know, based on that particular strategy. Coming back to the vol crush, so you know, there's Microsoft here. So we can see Microsoft, we're looking at earnings date here, somewhat sideways. You know, if you look at earnings here, spiked up, but then somewhat sideways. Same here, sideways. It did drop down and then sideways. So depending on where the expected move was based on that earnings, I'd have to see if that broke through. I think that one lost money on the first one. It did. So we can see that trade 10, which would be this trade here, actually did lose money. But, you know, we lost a little bit of value. I mean, not a huge amount, $95, but we can see the credit that we've received on some of these versus the actual profit that we were able to make. So fairly, again, short-term trades, you know, using weekly options, you can test those other options, but I think weeklies are going to be our best strategy for this type of trade. There's our profit graph. Yes.
Hey, there's a question just about like your typical amount of trades during earnings season, like how many?
Yeah, no worries. Yeah. So before I'll go to the next, I think, so this page you can see that for the vol crush, it's somewhat light. Again, we're talking about only 40 trades total that I have over 60% win rate. And as Josh mentioned earlier, you know, we're looking at end of the day data. So 60% win rate is, I think, something that you can kind of look at and analyze, but it's possible that you were able to get out the next day after earnings before the close and still make a profit and get the 60% win rate up a little bit higher. But yes, before I was using a different screener within Delphian to find stocks that match this criteria, and I was using a fairly wide bid-ask spread. Let me show you, what I'll do is at the end of this slide, the next slide, I'll show you my earnings slide, the iron butterfly, the vol crush trade, the sheet that we used for the share drive, and I'll show you how I had a list I think of over a couple hundred, and how I was able to bring that list down to a handful. So the list can be pretty wide, but you really do need to, the list can be pretty big, but you do need to be careful of the bid-ask spread of the options, the volume of those options that are traded, and the open interest of those options that are traded. The reason being is when you're dealing with the iron butterfly or the vol crush trade, it is a four-legged spread, so you're basically dealing with four options and you're trying to get one price together as a whole. So when you do that, you want to make sure the open interest and the volume on all those options is fairly liquid, because if it's not, one leg of a four-legged trade could really mess up the bid-ask spread on that trade, or really make it difficult to get in and out of that trade when you want to do so. There's not much that I can think of trading-wise that is worse than picking a strategy, being right, and then finding out that that strategy wasn't optimal, either based on liquidity of the options, or whether liquidity of the stock, or whatever it is. So the list can be pretty big, but I've got this list down I think to about 40 different trades, as we say here, 40 potential trades over 60, and I think that's well enough trades to be looking at for one earnings season, because you're talking about 90 days, 40 trades. That's quite a bit, right? So you can expand that list to make it bigger, but again, just bigger isn't necessarily always better. Just make sure you're able to screen out those stocks appropriately based on that, like we talked about, volume, open interest, and the other one I didn't mention was implied volatility. I think those are three huge factors of what you want to analyze before getting into some of these trades. So yeah, 40 potential trades with a win percentage over 60, 17 over 70, 9 trades over 80, and 2 over 90. So again, we're going to be tracking it using a different source. This one again is really important trade to pay attention to the earnings announcement time. If it happens before market opens, you want to make sure you're getting into the trade the previous day, because if earnings comes out tomorrow morning after the close tonight, you can't get into the trade. So you're pretty much, you missed that one. If earnings comes out after the market closes, then I would say you typically want to try to get into the trade between 3 p.m. To 4 p.m. Eastern time if you can. During the day, you might get a big move up or a big move down, and that could change those at the money options dramatically. So, typically want to wait till about 3 o'clock in Eastern time, p.m. Eastern time if you can. We're always going to look at, we want to verify our risk versus reward on a trade like this. So how much money am I collecting versus how much money am I risking? If you think of something like a $200 credit versus $800 worth of risk, isn't that great of a trade. But if you can find something where you're risking, you're collecting 500 and then you're risking 500, that's a 1-to-1. It's getting better. Some of these trades we can find a 2-to-1 reward to risk. So meaning, I have a credit of $1,000 and I'm risking 500. Those trades aren't out of the ordinary for this type of strategy, and those are the trades that I typically will try to gear towards if I can. You want to look at implied volatility. There's 2 key components there. There's a relative volatility and there's a current. So what is the relative volatility or implied volatility for that particular stock or that particular option during that time frame in a normal scenario, and what is it currently now? So has that volatility or implied volatility increased, and to what degree has it increased? Again, you want to look at your open interest and your option volume as well. With these trades, 4-legged option trades, I'm always going to use the limit order, and I can kind of adjust the price as I see fit. Always understand the potential risk on the trade. So you're getting a credit, you're using those outer legs to protect you, but how much protection are they offering you? Again, always have your trading plan ahead of time, know what you're going to do if something happens. In the past, we have seen some of these where you're dealing with options that are at the money prior to earnings. So when earnings comes out, there's a highly likelihood that one of your options is going to be in the money that you sold. So it is possible at any point in time that you could get exercised on that option. So if you do get exercised on an option, as long as you don't make an adjustment to the other 3 legs of the trade, your trade is still intact. Don't get too concerned with the fact that, now you're short 600 shares of Apple. If you haven't made any adjustments to the other legs of the option of the butterfly spread, your trade is still intact. So you still want to manage all that trade appropriately. But don't be concerned with something like that happening. Obviously, if you have questions, speak to your broker. You can speak to myself. I can talk to you a little bit about it. I can't tell you how to trade it, but I can kind of give you some advice on what might be optimal or ways that you could handle something like that. But always have that plan in place, so you're not caught off guard when something like that does happen. Again, once I enter into the trade and I'm filled, I go ahead and put my 40% credit. Basically my 40% profit of the credit I received. I put that order in GTC and I kind of let the trade play out. These trades are great because earnings happens that night or in that morning. So with the move on earnings, you're in the trade and you can actually see kind of where the stock is, where your break evens are, and you can figure out, with a little bit of help of kind of where that value of that spread should be. And that'll give you a good idea of kind of what's happening with that trade prior to the market even opening. So, but I do go ahead and put my 40% profit in, right when I get filled, so I can put it in GTC and try not to worry about it. Again, like some of the other trades, if you're not out for a profit that morning or shortly thereafter, you just want to make sure you're out by the close of that day. That's how these are tested. If you want to back test them using more days, then you can do that and see. You might get some better results with some stocks, or you might get some worse results. But again, before you just make adjustment on the fly, make sure you tested it and make sure it was part of the plan. That's it for the vol crush. That strategy is a little intense. It is a 4-legged spread, so it is somewhat of a harder trade to understand. But feel free to contact me if you want more insight on that trade or kind of how those trades work. I would hope we'd have some questions about it, but let's see if we have any questions about that one. I see some chats coming through, I think. Okay, and then yeah, so again, that brings back to what Josh had just mentioned a second ago, sorry. So let me go in there and show you the, let me see what I have for some of these. So I did a lot of these different spreadsheets, so bear with me, I'm running through some of these spreadsheets. So this is the earnings fly, which again is the iron butterfly spreadsheet. Here's the screener that I used, and similar to what we talked about on the earlier page. So when I just run the screener using all of the options available or all of the stocks available, I'm looking at a list of 246 stocks. What is it? 246 is because I have my header there. So 246 symbols. So I'm like, wow, that's way too many. Some of these symbols here we can see have a negative profit factor. So they're on average, they're probably losing money. So then what I wanted to do was I wanted to come in here and I wanted to look at, I wanted to find ones, again, using a different option spread. So I wanted a tighter bid-ask spread. Another way you can do that with the tight bid-ask spread is you can use weekly options. Stocks that have weekly options, their bid-ask spread will typically be a bit tighter. However, that's not the case for all. So I wanted to come in here and try to, use a different screener to find a better, more manageable list, if you will. So 200 and something here. I did all above 60% so all above a 60% win rate and a positive profit factor, and I still have 100 symbols. So I'm like, all right, that's still quite a bit of symbols that I can look at. So how about if I go 0 to 1% bid-ask spread, 60% win rate with a positive profit factor, and then I get a list of 40 symbols. So a much more manageable list in my mind that we can use. We can see some of these. You can see Amazon, Google, Microsoft, some of these that are really BSX, that are really great symbols that you can use. Starbucks. There's a couple here that don't show up on the list, and that just means that the win percentage might be less than 60. But one that sticks out in my mind that's not on here is Tesla. Tesla is a really good stock for this particular strategy. However, it is fairly expensive. Everybody, wants to get into Tesla or wants to trade Tesla, and then when earnings comes about, that is a big mover, and that does have a huge amount of volatility come into the stock. So, if my memory serves me correctly, last Tesla earnings, the most recent earnings, I want to say that the expected move was around, let's just say $150. So $15,000 on each side is the expected move when you're trading options. So for a trade like that, I might have received a credit for $11,000, but if I receive a credit of $11,000 and my expected move is $15,000, that means my actual risk is $4,000 for that trade. So I'm able to collect $11,000, but if it moves way outside of that range, I do have $4,000 worth of risk that I could lose in, essentially a 24-hour time frame of a trade. So a big amount of risk for most people, a big amount of risk for me as well. Doesn't mean it's some people can't do it, just that you have to know what that risk is ahead of time. But I think I'd seen the day before Tesla had come out this past earnings that more often than not, I think this is on Thinkorswim or some other news source, but more often than not, after earnings, Tesla stays within a pretty tight range, and that's pretty much what it did. It did stay within a fairly tight range after the earnings announcement. So stocks like that, might not be on this list, but depending on your risk tolerance, you might want to test a little further to find those out for some good candidates. Amazon, we all know, is a high price stock, so that one's going to be the risk profile, and that one's going to be pretty decent. Google, the same. Your risk on those are going to be pretty decent as well. So just always be prepared for that risk. But I was able to get the list down from over 200 to about 40. So I think this is a great list, and we can, like I said, optimize on that further as well. Let's see. So I'm going to pull up the bullish runner.